Hi everyone, welcome to today's video. I'm Talking Sense David, and if this is your first time here, please do hit that subscribe button. In today's video, I'm going to be looking at technical analysis and the fundamentals of a company. And I'm going to be paying particular attention to the 50-day and the 200-day moving averages. Now, I like to use the technicals and the fundamentals to help me in my decision making because I think it's the best approach. So we're going to start with Standard Bank. And we can see just by the chart that's in front of you that Standard Bank is in a clear uptrend. Now I'm going to point out how you see that. You can just clearly see that it's in an uptrend there. But the key signal is that each time it pulls back, it creates a higher low. And every time it rallies up, it's creating a higher high. So that's two very good signals immediately. That's telling me that the continuation of that trend is being supported by higher demand, more people wanting the shares, which is obviously being caused by the fundamentals of the company, which we'll look at shortly. Before we look at the fundamentals, I want to just zoom into the 50-day moving average and the 200-day moving average. The yellow is the 50-day and the purple is the 200-day moving averages. So we'll see that up until recently, the stock was above both the 50-day and the 200-day. Why is that important? Is because I believe that shows that that's momentum. And when I take trades, I like to find stocks that are above the 50 and the 200-day moving averages. That's just showing me there's strong growth, strong demand, and the price is in an uptrend. So up until recently, it was above both, which you can see now it's below the 50-day moving average. And it bounced off that 200-day, which is acting as support. Now, I want to emphasize that because in the next chart we look at, the 200-day moving average is acting as a resistance. Yeah, it's acting as support. So as long as Standard Bank can remain above that, or if it does fall below that but reclaim it quickly, then the momentum is still to the upside. Now, this fall in the share price, I don't think is particularly too concerning because I believe that it was a market sell-off and not a Standard Bank specific issue, which I can just clearly see that by the first rand chart. You can see that same structure where the price just collapsed. What's different is that first rand hasn't had a recovery as Standard Bank has. Standard Bank is trying to close that gap, and if it can reclaim that 50-day moving average and stay above it, then most likely we're going to reach new 52-week highs. And the 52-week high on this chart is the orange one above, the 52-week low is the orange one below. So that's the first few signals I look for. Simple, volume increasing, higher lows, higher highs, above 50-day moving average, above the 200-day moving average. I can see that's the uptrend. Now let's look at the fundamentals and see how that's supported and if the fundamentals are improving, which then gives me more validation and a bit of more conviction that the price could potentially go higher. So we'll start off with the active clients. We see that Standard Bank has grown active clients to 15.4 million, which is 9% higher than the same period last year. Their corporate banking and investment banking division generated 33 billion of their revenue, 32% higher. Now what we really want to look at is the revenue of the group. How is that growing? So the total income for the period of the first 6 months of 2023 was 75 billion rand, which is up from 59 billion rand from the same period before. So that's significant growth. That's 20%, 27% higher. All right? And that's telling you that they are benefiting from the interest rate increases, which I can see by the net interest income. Now, for those of you that don't know what the net interest income, that's the difference between the revenue that it's generating on its assets. That's the loans. That's the loan it makes to you and charges you interest. That's their asset. So it's the difference between that and the cost that it's paying on its liabilities. So the liabilities are the depositors' money. So the depositors that are keeping their money in the bank and earning interest. It's the difference between what it's lending out and paying the depositors. We call that the net interest income. And we can see that just from the same period, 6 months of this year, to the same period last year, the 6 months of last year, the first 6 months of last year, that they grew their net interest income purely from interest rate increases by an additional 12 billion rand. That's incredible. It's a 35% change. And that's contributing to the group's overall profits. We can see that in the graph. Not that one. Let me go back. Should be that one. There we go. The net interest income, NII, and the net interest margin. The net interest margin you can see is in the blue, and the net interest income is rands per billion. So in 2019, the first 6 months of the year, they were making 31 billion, 0.2. That was constant, same period in 2020. It was only now that it's starting to really intensify as interest rates rise, they're making more money. So it's a positive impact for them, and that's how they are growing their revenues. So I just want to quickly go back to that. There you can also see their non-interest revenue. So that's revenue that they're earning that's not associated from earning from extending loans and making interest from the money they're lending out. You can see that is also higher. It's gone from 24 billion to 29 billion. So my point is there is underlying growth in the company, in Standard Bank. The question is, how can they benefit going forward from that? If interest rates are going to stay higher, then their net interest income is going to stay elevated for a while. The risk that you would have to look at then is the non-performing loans. That means the people that are taking the loans, are they able to service that debt? Because that's now a risk for the bank. The bank might have non-performing loans and people not giving that back, the money back that they borrowed. So we see that in the loans extended, 1.4 trillion rand has been lent out by Standard Bank, and they have 1.8 trillion in deposits. Now, they have to keep a certain amount of capital to service those loans or service withdrawals. Remember, a deposit is a liability for them. That's people's money. That's your money, my money. And a loan is an asset because that's how they're generating income from themselves. So their liquidity on hand, their capital ratios are good. You can see that SARB requires them to keep 8.5. That's the South African Reserve Bank. But their target ratio is almost double that. So they've liquid enough to maintain withdrawals. They are earning increased profits from higher interest rates. Their revenue is growing. Their active customers are growing. And that is feeding into their share price, which we can see on the graph over here. Now remember, the market is a discounting beast. It's discounting the future already in the present moment. So what we've seen, this increase, has been savvy investors anticipating growth for Standard Bank and buying the share at a discount or at a reasonable price, expecting that it to go. Along the way, the certain pullbacks might have been traders or firms that were looking for return, exiting, selling out, because they need the liquidity to sell out. But what we see is that strong momentum, and why we see that pullback there, that orange line, is because it's hitting its head at a resistance. The question now is, can it break higher? The only risk that I would be aware of is the non-performing loans, and if there's a deterioration in the business, which doesn't look like it's happening at the moment. So if I were to enter in this position, I know I'm above the 200-day. I would likely see, I would prefer to see it above the 50-day moving average too, but I could expect that it could come down into that area there, and that would be a good entry in my opinion, 160, 170, and it would still mean that it's a higher low. So I would exit if it got lower than 150. So if the stock tested the low and didn't hold and fell below the 50-day and the 200-day moving average and did something like this, I would exit over here, because now it would be saying we're putting in a lower low. So if you see the chart like that, that would be your exit sign, because now it's putting in a lower low. I would exit. So at the moment, strong momentum in Standard Bank, fundamentals are looking good. It's something to put on your watch list, and I would say that 165 could be a good entry point. Now I'm going to flip over to Exxaro, and we're going to look at the technicals as well as the fundamentals. So the first thing I'm going to point out is the beautiful channel that Exxaro is in. It's been trading in that zone since 2016, which means the low over here, the high over there, and you can see as it rallies up, pulls back, hits that top area again, pulls back, bottom of that channel, and that was the pandemic flush out. It recovered back into that zone, retested that zone again, and continued up, hit the upper bound of that zone, and pulled back. So we'll see that this area here is a point of interest, and that obviously now in hindsight would have been a nice trade area, but we can see that that is an area, as it got there, reflects, it coincides with the upper end of that channel, pulls back in a resistance area, tries to retest again, fails, retests again, breaks out but cannot hold it. It doesn't hold it. Tests it now, becomes a support, but fails. Subsequently tests the bottom of that channel and finally breaks out of that area that was of interest. So there, the breakout, retest down, perfect buying position right there, riding that rally up, selling, and then that strong momentum up. So remember, the chart itself is discounting the future. So this pullback was discounting something that maybe the retail investor didn't see, or someone that's not as market savvy as someone that's got an analysts of a team of analysts or data at their disposal. Now, before we look at the fundamentals, I want to zoom into the 50-day and the 200-day moving average. So remember, I like to trade stocks that are both above the 50-day moving average and the 200-day moving average. So Exxaro is now above the 50-day moving average, and it looks like it's trying to reclaim that 200-day. So if it broke out of that 200-day, I would want to see a structure like this. Resistance line, breakout, retest. At the retest is where I'm going to buy. But for now, it's hit its head on that 200-day moving average, which is acting as a resistance. Remember, whereas Standard Bank was acting as a support. Strong momentum, see if it can hold, whereas Exxaro has weak momentum, been selling off, and it's trying to reclaim. So between Standard Bank and Exxaro, I would say Standard Bank has the momentum in its favor. But I would want to keep Exxaro on my watch list, because if it can get back above that 200-day moving average, hold and push higher, then we can see that there is upside potential to the next area up here. So we're looking at 200 Rand, maybe 210, 215, 220 up there. So if it can break, hold, and potentially push higher. Again, I would set stop loss somewhere here in case it breaks down. But you can see that every time it hits that lower end of the channel, sometimes it overextends, but it usually reclaims to stay in that channel. There it reclaimed, entered in a nice area that's very interesting, where people come in to buy. If it doesn't hold, then 120 is the area where I would take a position. So we're going to look at the fundamentals now and see how that feeds into the stock. So this is for the first 6 months of 2023 too. Remember, Exxaro is a cyclical business, which means when it returns, when its momentum is to the upside, it's going to give you good profits. And the opposite is true too. When the cycle is going down, the price is going to collapse quicker than other stocks. The reason for that is because the underlying commodity, coal itself, has gone from 350, just over 350 or just below 350 there, to 100 tons, $100 per ton. So that just the underlying commodity losing value, or the price adjusting downwards, has compressed the margins of Exxaro, which is a clear risk for them. You can see pressure on the profit margins. That's simply because their input costs are rising and the underlying commodity price is collapsing. So the main focus for them is cost containment. You'll see cost containment an imperative, which means it's important that they contain their costs. They need to balance those margins as best they can. The question though, and the risk, is if the coal price doesn't stabilize, and let's just say it had to collapse, you can only contain costs so much before the business becomes unviable, which means you might have to lay off staff drastically, close certain mines, whole bunch of restructuring. So they might even have to take on risk and lose money in the interim until the price recovers, for example. I'm not saying that's what's happening, but you can only contain costs to a certain degree. The price of the commodity is what needs to stabilize for long-term viability. In South Africa, themselves, they are saying it's a tough place to do business. Now, why is that important? Just here on my Twitter page, I put a thread the other day. Their revenue for the first 6 months of 2023 was 18.9 billion. 13 billion of that money is coming domestically. So although the price of the commodity they're exporting, coal, is priced in dollars, their input costs are rising too, in rand terms, because of cost-pushed inflation. But the exports is not a big chunk of their overall revenue. Most of the revenue is coming domestically from public utilities, which is most likely Eskom, which we see here. Lower demand from Eskom due to short-term disruptions. Intensified electricity shortages continue to require solutions. Rand volatility due to perceived jurisdiction risk. So jurisdiction risk is South Africa. Means people are adding a risk premium needed. The risk premium is higher. So for you, for South Africa or a business in South Africa, for me to want to invest in them, I have to be offered a return above and beyond what I can get in the risk-free rate. So let's say, why am I going to invest in a business that's only going to give me an X amount of return, which is not very exciting, when I can keep my money in cash, in a treasury or money market account in dollars itself, and earn a risk-free without really much of the volatility of the stock price. So that's the perceived jurisdiction risk. It's the risk premium needed for someone to invest in South Africa, in the stock, in this business. So there's a lot of demand that's been pulled out because people are now taking their capital to somewhere else where it's less risky and they can earn a return without any of the volatility. The rand volatility, you'll see that the first 6 months of 2022 it was at 15.40, depreciated quite a bit. Now the 6 months of 2023 it's 18.21, which is resulting in social economic challenges. And this is feeding into businesses in South Africa, which is causing the risk premium to rise. So this sort of risk, and Exxaro right now is considered a riskier bet. So if you believe that the macro environment is going to deteriorate further, then this wouldn't be a business that you would want to take a position in now, because your money could be invested in something a lot less riskier and you would have stable returns. But when the cycle turns, this could be a big play because the returns could be greater, but also on the downside your returns are lower. So you have to balance that risk management and find that position where the ideal entry is in the short term. So we're going to look at some of the earnings, earnings before interest, tax, depreciation and amortization. I think that's EBITDA. That's not Ibiza. Anyway, you see that's 7.7 billion, which is still pretty impressive since the coal price has collapsed. But that's from containing costs, which we'll see now. Their revenue shrunk a bit, 21%, and their earnings has been it's still relatively high because they've been able to contain costs. But like I mentioned earlier, you can only contain costs to a certain degree. So if the commodity price doesn't stabilize, or if there's a wider issue, then those margins will compress further. Here's what I'm talking about, the revenue for the first 6 months. The 6 months, the back half of 2022, so June to December, you'll see that Exxaro made $24 billion in revenue, which is a 21%, 18 billion in 2023, first 6 months, which is a 21% decline from the 6 months ending 2022. So there's that 21% decrease in revenue, but them being able to contain their costs only resulted in a 9% earnings compression, which is, it's good management. They're containing costs below in their mining inflation, the inflationary input costs. They're containing those costs quite well. So they are aware of the macro environment. The management team seems savvy enough to make the necessary adjustments or the tough decisions to maintain the stability of their business. They were still able to pay an interim dividend of 11%. If the current price is 177 now, that would be a 6.5% dividend yield just for this 6 month period. So you're looking at maybe 10-11% dividend yield over the year if you had to invest in Exxaro. But remember, that's a lagging indicator. So if their margins compress further, or if their revenue compresses, their inputs rise, then that dividend yield will also compress. So you have to discount that into the future, and you do an analysis to see what are the risks, if it's worth investing for the dividend yield, if you see capital appreciation in the short term. This is why I will relate it back to the technical side. So that's just a brief overview of the fundamentals. We'll end the video now shortly. But again, look at Exxaro. Nice channel. The positive is that it's re-entered that channel that it's been trading in since 2016, and it's at the lower end of that channel. It's above its 50-day moving average, but hitting its head on the resistance, the 200-day resistance. So if it can reclaim that 200-day resistance level and stay above it, break it, retest it down, that's the entry point right there before it moves higher to the next area. Ultimately, if it cannot break and stay above that 200-day moving average, then we're looking at it going down, and the 50-day moving average will be the support. Could be a bounce, but if it cannot break higher and find that momentum, and there's a larger macro scare, margins decrease, then you're looking at potentially breaking down to 120. So that would be ideally a good position for me if I were looking to enter. For now, it's a wait and see. I would want to get above that 200-day moving average, make a trade to 200. As long as it can stay in that channel, gradually get above those areas, then and the coal price improves. So there's a lot of parameters, a lot of risks, but something to keep an eye on and keep a watch on. Alright, so we're going to end the video there. Just to sum up everything, look for stocks that are above 50-day moving average, above the 200-day moving average. Fundamentals are improving over time, so it's supporting that growth share price. And ultimately, between Standard Bank and Exxaro, which is the better stock? That would be a great question. If you can comment below what you think it is. Personally, I would opt for Standard Bank just because the momentum's there, but Exxaro is getting exciting. I want to see if the coal price increases. Europe is going into winter now, if I'm not mistaken. And what that means is if there are any geopolitical games, oil embargoes, coal could be a beneficiary again. That could mean Exxaro is a beneficiary. But a lot of moving risks, and ideally is don't buy the tops. you want to be buying areas where it comes into strong support lower down. Those are the areas you want to be looking at buying. So keep Exxaro on your watch list. Could start nibbling potentially. Standard Bank probably has the best upside potential. But let me know what you think in the comments, and if there's any other stocks you want me to look at, the fundamentals, the technicals, compare stocks, let me know in the comments. Thanks again for tuning in. I hope you found value. If you did, like the video, hit subscribe, share with your friends. So until then, I'll see you in the next video. Bye for now.